Dave Ramsey is a household name in the financial industry. His life's mission is to get as many people out of debt as possible and show the exact steps to take in order to achieve financial independence and financial freedom. I won't go into all of his steps, but he encourages people to first pay off all their debt except for their house and then build an emergency fund of 3 to 6 months of expenses. And then you should invest 15% of your income consistently in a mutual funds. Let's talk about what mutual funds are. Basically, when you invest into a mutual fund, you contribute to a pool of money managed by investment professionals. These professionals use the money and invest into different assets, such as stocks, bonds, money market funds, and they also can keep some of it as cash in case they want to use it to buy other assets. When the mutual fund increases in value, the profits are shared with its investors, and then these profits can be used to reinvest into the fund. Dave Ramsey lives by a buy and hold strategy and doesn't try to time the market. He also emphasizes that how long you keep your money invested is much more important than what funds you choose. Another way of saying this is that time in the market is better than timing the market. Let's compare mutual funds with index funds. To do this, I'll look at the most common index fund that mirrors the S&P 500, which contains 500 of the biggest companies in the United States. SPDR, which is the index fund, has an average annual return rate of 11% and a very low expense ratio of 0.01%. The average mutual fund returns 9% per year and a higher expense ratio of 0.75%. The expense ratio refers to the amount that you have to pay in order to invest in the mutual fund or the index fund. A higher expense ratio means you pay more money. A small difference in the expense ratio can result in a huge difference in your money returns over a long period of time. This is due to the power of compounding. Each year, the fee is taken off your portfolio and will not be able to compound since it's gone. Dave Ramsey says that he invests in mutual funds that return an average of 12% per year. A lot of people don't believe him, but a simple Google search suggests that there are indeed mutual funds that return an average of 12% or more per year. Here are a few of them. For example, the Growth Fund of America, AGTHX, has returned an average of 13.79% since it was formed in 1973. However, I'm more of a fan of ARK, which is an actively managed ETF, or exchange traded fund, basically an index fund. Its return rate since it was created in 2014 has averaged 35% per year and has an expense ratio of 0.75%. Although this is a higher fee, its returns are much greater than mutual funds or the S&P 500. Here's a visual example of ARK versus the S&P 500. It has been significantly outperforming it with no signs of slowing down. I truly believe that this is a great long-term investment. So which is better, mutual funds or index funds? I really like the ARK index fund. However, a mutual fund with higher fees and lower returns is much better than not investing at all. A mutual fund with higher fees and lower returns is much better than not investing consistently. And a mutual fund with higher fees and lower returns is much better than panic selling your stocks or investments. If you don't have the discipline or motivation to invest consistently, or you don't have the discipline or temperament to hold and not sell, you should hire an investment professional. They will keep you accountable and make sure you invest consistently, and also make sure you don't sell at the bottom of the market just because you're scared. This will of course cost you money, but those fees will be a drop in the bucket compared to the returns that you'll get on your investments over the years. The bottom line is to just do it. Commit to investing consistently and do not sell or hire a financial advisor. If I were a brand new investor and did not know what to do, here's what I'd do. I would invest a percentage of my income into ARK consistently, and I would automate this process so money from my paychecks get transferred into my investment account before I even have a chance to spend it. You need to do this consistently and do not sell. The only time you should consider selling is if the fundamentals of the index fund change or you retire and want to use some of your gains. You need to commit to the strategy of investing for many years. It's important to note that successful long-term investing is boring. Just ask our friend Dave Ramsey. He has been consistently investing very conservatively for many years. He went from a broke 29-year-old to buying this house in cash many years later. There's no secret to his success, just patience, persistence, and implementing the principles outlined in this video. Thank you so much for taking the time out of your busy day to watch. Please leave a comment below, like the video, and subscribe if you want to see more.